Again, my name is Nicole Fisher with Marshall Reddick Real Estate. Also with me tonight is Tony Watson with Robert Hall and Associates, and he's going to be talking about how to protect your wealth and keep more of what's yours. We all want to keep a little more of what's ours these days. Just to let you know, we are not going to be doing a live Q&A at the end of the webinar, just so that it doesn't run too long. But if you have any questions, please do type them into the chat box. And I will work on getting answers to those questions back to you in the couple of days after the webinar. So definitely do ask questions. We just won't be able to answer them during the call. I will go ahead and start the first slide. Before I bring Tony on, I'm going to talk to you guys a little bit about Marshall Reddick Real Estate and who we are. We've actually been around since 1979, and we're a full service real estate brokerage. We operate in California and also in several out of state as well, buying and selling investment properties, but also your primary residence, second homes, that sort of thing. We do property management as well. Property management is very important, especially with our investments. You know, once you buy that property, you know, there's so much money can be made or lost with how it's managed after the fact. And Marshall Reddick has property management now in our key areas out of state and in California to help investors with that. We also do private money lending. We help match borrowers with investors that basically want to be the bank to you know, one-to-one property, and we have lots of information of this on our website. And again, this is something that I could talk with you more about as well. But the private money lending, again, you would be the bank on a mortgage of a property. You would be dealing with releasing the lien, and it's a little bit of a hands-on type of investment. We also have an investment fund that's more passive if you're not wanting so much of that hands-on direct bank. It's something that's a little less time consuming. And then down here, we also have a huge Rolodex of contractors, property managers, lenders, CPAs, you know, over the last 40 plus years working in California and across the country. We've got a lot of great relationships and gotten to, you know, work with many different people that can help you through the transaction from beginning to end. And that's basically what we're here to do. We're here to make it as simple as possible for you to invest either in California or out of state, and make it a seamless end-to-end, you know, one-stop shop for our investors. Let me go to the next tab. And this is me. My name is Nicole Fisher. I am an advisor here at Marshall Reddick, but I actually started out as an investor myself. My first career was in finance and accounting. I got my CPA out of college, and I came to the Bay Area of California to work in audit, and I did a lot of the tech companies up here, and worked in corporate finance for quite a while. And the whole time I was working in finance, though, I was always interested in investing in real estate, and I was going to meetups even back when I was cramming for the CPA exam. And I was trying to find the right investment, you know, for me. In California was very expensive, and a lot of the options here just were a little riskier than I was wanting. And I was lucky enough to find Marshall Reddick in 2015 at a meetup where they spoke about investing out of state, and it was kind of like an aha moment for me. I started working with Marshall Reddick. I bought my first out-of-state property with Marshall Reddick, and from there I also did some private lending and invested in the fund as well. And 5 years ago, almost 6 now, I had my first daughter, and now I have 2. I also have a 3-year-old. And after my second daughter was born, I was basically ready for a career change. And I had always loved working with Marshall Reddick and the team, and again, always, you know, loved real estate and investing. And so it just made sense to go ahead and get my real estate license and then join the company that I had really been, you know, working with for for quite a long time. So that's how I got here as an advisor. And in this role, I talk with new investors and seasoned investors, about their investment goals and your plans, and basically help guide you along the way of, the various real estate investing that you might like to do. And I really enjoy the role. It feels like a mentorship to me. And I really just like, sharing the information and helping other people do what I was able to do with the company. These are our markets. You can see we operate, in several states throughout the country. The green boxes here, these are those that we actually have a Marshall Reddick brick and mortar office there, where we have our own agents and property managers. The other areas we operate in as well, but we contract in those areas. And you might be wondering why these areas specifically. And no, it's not because we just happen to have offices there. We actually spent a lot of time over the last 40 years analyzing all these different criteria to really hone in on those areas that are going to be really strong, for investors. So these are the 7 areas we look at. We look at job market. We want to have a very diverse market that, isn't a town that's just, has one industry that if that industry doesn't do well, everything tanks. We look at vacancy rate, economic diversity, housing affordability. It's investors want cash on cash returns too. It's not just about appreciation. And so we look at, areas where does the rent cover the mortgage and the property taxes and the insurance. We look at if a state is a landlord-friendly state. If you're from California, California is not a landlord-friendly state, but not all states are like that. And definitely, having a rental property in a landlord-friendly state definitely is a way to go. Also, strong higher education. Again, kind of going back to the economic diversity, a lot of these cities that we work in also have military. So we have military, higher education, lots of diversity in the economy, tourism, a lot of different things that help hold those areas up. And then the biggest one is reliable property management, because again, you've just invested so much money in this property, and that is your investment. But what happens after you purchase that investment is extremely important. And that's why Marshall Reddick is also here to help with the property management as well, getting tenants placed, and then obviously maintaining the property, for years into the future. This is our Reddick property rating ebook. This is the link down at the bottom. And this this actually has a lot of detail in it. When you look at properties on our website, you'll see they all have a rating, A, B, C, or D. And so this is a great place to start, when you're looking at our website and trying to understand the different properties, how we do some of our calculations. A lot of it seems like it would be intuitive, but it's actually, different than you may think. So I highly recommend that you all look at this ebook. And here's the link at the bottom. I'm happy to email the link to you as well. And then here is, what can you expect from a consultation with an advisor? So again, Marshall Reddick, really, we want to be a one-stop shop, just providing end-to-end service for investors. And I'm basically the starting point for that as your advisor. You can kind of think of me as your concierge. Like, you want to invest, you're not quite sure what you want to do, you give me a call, and then I basically help you through the process. So, if you're a more seasoned investor, maybe you already, know a lot of this. Maybe you already know what your goals are, and your time frame and your criteria, and maybe you even already know what market you are interested in. In that case, we would just talk a little bit, and then I would be able to help introduce you to the key players in those markets. But, maybe you're a brand new investor and you don't know what your goals are, or you're not sure which markets you're interested in. And in that case, we can talk more about your different options, and I can help you kind of work through that process to decide on, what type of investment's the right one for you, and, which market. And all of our consultations are completely free. this is my contact information. This is my number here, my direct line. You could always call or text me, email. If you're in the Bay Area, we can meet for coffee. It's nice to get out these days. Everyone's working from home. But yeah, so would love to have a consultation and just hear where you are in your investment journey, and see what we can do to help you. And with that, I will go ahead and transfer over to Tony.
Great, thank you so much, Nicole. You sure are right about California not being a landlord-friendly state. I have lots of current clients at the moment dealing still with some renter issues. Obviously people living in their property for a very long time and not paying rent, which is as a business owner, myself as a rental property owner and a tax preparer, tax professional that helps close to about 1,000 real estate investors just in my own column alone on a year-to-year basis. It's really important to know where you're investing and some of the opportunities that you can take advantage of outside of the state of California. And if we were all investors that bought property 30, 40, 50 years ago, the appreciation alone makes it worth it. But man, oh man, during the last 2.5-year period during the pandemic, when the eviction moratorium went into play, that was a big time hit for a lot of property investors. So just keep in mind that California is not the only state that has great investment opportunity. And that's but one major reason why I love working with Marshall Reddick's team. They have good perspective of real estate investing across the US. And back when I first met Marshall Reddick and Scott and all most of the team over at Marshall Reddick, they only had one location in Southern California. And now look at how they've expanded. They just found a great opportunity elsewhere in the US. So a big part of today's conversation on my end is how to protect your wealth to keep more of what's yours, basically building wealth within the wonderful world of real estate investing. My name is Tony Watson. I work for Robert Hall & Associates. If you've heard me speak before, you know how passionate I am about the world of taxation and obviously real estate investing, and how those two industries go hand in hand in more than just a couple ways. I've been doing this, gosh, I think this will be my 18th year now, outside of the first maybe year or two of me interning under Robert Hall Sr., the founder of the company, who's been, this business has been in, based here in the Southern California area since 1971. We are filing as a firm just around about 10,000 tax returns per year. So obviously we see a lot. Anywhere from the small business owner to the startup real estate investor, and then we have clients who own over 100 properties in their portfolio and are doing great things in the exchange world and the syndication world. So we do see a lot here at Robert Hall & Associates. We've won a number of awards here in the Southern California area, and I think that our clientele roster in total, for our whole clientele roster, the 10,000 plus returns, we're well into the $1 billion marker for real estate operations management and wholesaling. So like I said, we see a lot here at Robert Hall & Associates. I myself, like I said, 18 years in the business now, not only a licensed enrolled agent to prepare taxes and represent clients in front of the IRS, not only at the federal level, but across all 50 states. Aside from tax preparation, I am also the keynote speaker for our firm. In my column, individual column, I think I'm at the 450 million marker now. I need to update that number that you see there on the screen in real estate investments and other business dealings. And I also, as the keynote speaker, speak at over 140 plus events per year. So I get to talk with a lot of people. I get to meet very unique, see unique opportunities and talk with very unique business owners who have realized, especially and specifically over the past 2.5 years, that once again, California is not the end all for investing. I just this morning, actually, my first appointment today, they have 2 rental properties in Burbank, California, and they are in the midst, actually one exchange is already closed, but the other one is in process to exchange for over 25 units across the other states, mostly in Texas, Florida, and I think Wisconsin was the one that they were looking at, but they've already gone through the identification process, and they're well into the 180-day time frame, and the cash flow alone on moving from those Burbank, those high value California real estate investments into investments elsewhere, you know, less doors for more doors, they're going to see a significant bump in their cash flow in the upcoming years. So a very, very unique opportunity in today's world, especially as interest rates climb. People really aren't looking to fully exit out of real estate, but they're looking to shake things up, even though the interest rates are high. And some of you might have been around long enough to see those 13, 14, 15% interest rates. So we know that 5+% is not all that bad, especially when you're buying properties for pennies on the dollar elsewhere in the US. So just always keep that in mind. And we always want to make sure that the the cap rates are calculated or presented to you. The cash flow analysis is done by Marshall Reddick and their team, but also to make sure that you're investing in places where, even though you aren't hands-on with the operation side of the business, you have great property management boots on the ground in those parts of the US. And that's, once again, why I love working with Marshall Reddick and the team over there. I by no means am a one-man operation. We are powered by numbers. We've got a great senior consulting staff. Most of us are real estate investors and or small business owners. In fact, during tax season, Caro, as you see second from the right here, he and his wife own a restaurant here in Los Angeles called Whistlin' Dixie. I think it's in West Hollywood. So during tax season, he's preparing tax returns, and at midnight, 1 o'clock, he has to go and turn off the cameras and collect the cash from his restaurant. I mean, you're talking about a staff here that knows not only the tax world, but also knows the trials and tribulations of our real estate investor clients and our business clients, because we practice what we preach. I myself, I own several side businesses. My wife calls them my side hustles, but they're very much side businesses, not my full-time position like my tax preparation job here. But we also invest in real estate. We've got some investments here in California, some investments in Austin, Texas. And then my wife also owns a couple businesses, and she's been self-employed for, I think, going on 17 years now. So like I said, most of our senior preparers, we very much practice what we preach here. So you get great insight from people who are going through the day-to-day operations of business dealings, just like you are. We are not only a tax preparation firm, we do a lot of tax planning, business incorporating, internal auditing, financial planning, estate planning. We're kind of a one-stop shop for all of your financial needs. We do offer free consultations. I will end today's presentation on this screen, so you don't have to take down our information right now. Obviously, listen to all the bread and butter that we're going to hop into right now, all of the great information on the income tax side of things. But I did want to mention that we do have a way to get in contact with us and have a free 30-minute consultation with any one of our senior consultants. Okay. To start off with, let's talk about the power of incorporating just for a couple minutes here, because I feel like coming out of the pandemic years, we've heard from a lot of our clients about how they can better protect themselves, especially because of tenant issues or investing outside of California and not actively managing or actively participating in the day-to-day operations of managing these business investments. Clearly they can't fly, to another state every other weekend to manage the building or anything. So how do they protect their assets, their wealth that they've built for themselves, separately from all of the personal liability that they might carry on the individual side? Well, I mean, the power of incorporating lies in the asset protection benefit, and not only the asset protection benefit, but that's where it really starts. The LLC is probably going to be the go-to entity for you as a real estate investor. The LLC is meant to create greater liability protection for your large appreciating assets. I also call them large depreciating assets because the building itself depreciates, but the value of the building continues to appreciate. So in the accounting world, we say large depreciable assets, but in the investment world, we talk about it as a large appreciating asset. And the best way to separate that property, that investment, from your personal liability, all the liability that you carry individually as you drive around and do your day-to-day, live your day-to-day lives, is to separate title into an LLC and out from under your primary social security number. So the number one benefit of utilizing any of these three entities that you see here on the screen, the number one benefit is asset protection. And so asset separation equals asset protection and vice versa. Do you want to put 10 properties into one LLC? Well, you can, But at that point, like Bob Hall told me probably first week of working under his, under his column 18 years ago, was why would a client ever put all of their eggs in one basket, right? Why would you put 10 high valued investments, cash flowing investments under one entity structure and putting them all basically at the same risk? Still great asset protection under the LLC. But if somebody were able to pierce the corporate veil of an LLC and come after those assets, they can still come after all 10 of those properties. And so, not everybody will want to separate each property into its own individual LLC. But I can tell you right now that when you have paid off properties, let's say that you have a $200,000 investment property, you got a $400,000 investment property, and let's say you've got a couple other in the the $400,000 or $500,000 range, and let's say just for argument's sake they're all paid off. I mean, those we know for a fact from the day one of the calendar year, because those properties are paid off, they're going to be cash flowing. As long as the renter's paying rent, right? Obviously, that's the key thing here. But you know that they're going to be cash flowing. So why not protect that business, that dividend paying investment, that high appreciating asset separately from all of the other liabilities that your other investments carry, and especially all of the liability that you carry individually on a day-to-day basis. Here in the state of California, the reason why a lot of investors don't separate their properties into LLCs, individual LLCs, is because of the cost of filing each LLC. Not filing on the tax side of things, but filing it with the state of California. California is not only the highest tax state in the US, but we also have the highest filing fee in the United States. Each LLC, each C corporation, each S corporation that you own and file on a year-to-year basis will pay what I call a parking ticket to the state of California, which is a minimum of $800 per entity. So as you can imagine, taking your 10 property portfolio and putting each property into its own LLC, 10 times 800, you're paying $8,000 alone in California filing fees and California parking tickets. So you got to be aware of the financial obligations as well. It sounds great in theory to have great asset protection per property, but you also have to understand the financial agreement you are tying yourself into or signing with the state of California as far as that annual $800 filing fee is concerned. You don't need to put all of your eggs in one basket. You can do that for simplification, and it does create that greater liability protection, but not nearly as much as having each property in its own individual LLC. Here in the state of California, California hasn't hopped on board with something called the Series LLC just yet. Unlike Texas and Nevada and Florida, Delaware, and other states in the US, there's something called a Series LLC where you can put 10 properties into each of their own individual LLCs, but file it as one LLC filing fee. So essentially you're creating individual liability protection for each property, each of the 10 properties, or each property within the 10 property portfolio, but only paying one filing fee. California hasn't accepted that filing yet, because then they'd be losing what? In that scenario, $8,000 versus $800, you're looking at $7,200 in uncollected revenue for the state of California. And let's face it, California is definitely in the business of making money and spending money as well. So we just have to understand the financial obligations of filing elsewhere versus filing in the state of California, and whether or not that is important for you to actually have. Incorporating is not right for everyone. This is a conversation you need to have with your tax advisor, you need to have with your legal advisor, you need to have with your priest, your doctor, whoever you trust most. Have this conversation with them before going online and starting this entity. I've been in several panel discussions. I've logged into online YouTube tutorials to see what other accountants are talking about in our industry, and I can't tell you how much misinformation is out there right now about incorporating, about the tax code, about what's passed and what hasn't passed, about what looms on the horizon. So have this conversation with a licensed advisor, hopefully somebody that you've built a great relationship over the past however many years, because that is the information that you want to take to heart. That's the information that you want to apply as a strategy for your own investment portfolio. LLCs are not right for everybody, just like C Corps and S Corps are not right for everybody. In fact, rental properties are best in LLCs, but they're not great under a C corporation or an S corporation. Because if you put a property, I'll give you one example and I want to move on, but if I go out and I purchase a $300,000 property today under the S corporation, for instance, and let's say that 10 years pass and I want to take that property out of the S corporation and put it into its own LLC, or maybe even take title personally to the property. Well, when I bought that $300,000 property under the S Corp 10 years ago, my basis was $300,000, but the government sees that $300,000 not as a value of a property, but values of shares under the corporation. So you can't think of it as a $300,000 property. You think of it as a property acquisition, which is trading or taking the place of $300,000 in shares of the business. 10 years down the road, let's say this property is worth $1 million. So you've seen $700,000 of appreciation in value. You decide to take that property out of the S Corp, not sell it, just take it back to your personal name or maybe put it into an LLC. The federal government, even though you didn't actually sell the property, the federal government sees that not as a liquidation of asset, they see it as a liquidation of shares. So your basis in this scenario was $300,000 and you're selling these shares, the government seeing it as you selling these shares for the fair market value of the property at the time that you took it out. So for $1 million now, all of a sudden, you didn't sell the property, but you have a $700,000 stock sale gain, which will be long-term, but at the end of the day, you have to pay that. And that's why you don't put properties under corporations. You put properties under LLCs because LLCs are not owned by shares. They are owned by percentage. Okay, so also aside from the financial obligation, understand that you need to be working with an accountant who understands the tax side of the equation with real estate investing and entity structuring. Now, some of you might be thinking, well, Tony, I have the best insurance policy in the world. I don't need an LLC. I don't need a C Corp. I don't need an S Corp. I have great insurance. It's going to protect me in case anything happens. Well, yes, you are absolutely right. The insurance policy is there and in place to pay out settlements in case an unforeseen event happens, right? We don't know that we're going to get sick, so we have health insurance to fix or repair our bodies. We don't know that we're going to get in a car accident on the way home from work, so we have car insurance to fix our cars. We have liability insurance, malpractice insurance, E&O insurance. We all have insurance for a specific reason, and it's there to pay out settlements in case an unforeseen event happens. But what an insurance policy does not do is it does not separate your business and your personal assets. That is what an entity structure does, like an LLC or an S Corp or a C Corporation. LLCs, S Corps, and C Corporations, they don't pay out values, they don't pay out settlements in case an unforeseen event happens. So they do provide two completely separate benefits. So as you build your wealth in real estate, as you build wealth in business, you might end up opening all three of these doors. Now, when would you open that middle door? When would you start the living trust or the irrevocable trust or the revocable trust or the limited family, limited family partnership trust or charitable remainder trust? When would you need that trust? Well, unfortunately, one specific life event, normally 99% of the time, this major life event has to happen in order for a trust to kick in as a benefit. And unfortunately, that life event is death, right? So you have the insurance policy to protect you financially while you are working and operating your businesses and buying real estate and managing your properties. The LLC is to protect you from potential litigation while you are operating at certain levels of risk and liability. And then in death, to make sure that your legacy transitions to your heirs, your beneficiaries, in the most efficient, the most safe, the most conservative way, let's say, is to have everything owned under a living trust or some type of trust. So the insurance policy is attached to the property is owned by your LLC, and then the LLC is not owned by you in this scenario. The LLC is owned by your living trust. I call it the golden pyramid. I know that's kind of weird to say because you're thinking, oh, it's a pyramid scheme. Well, no. Pyramid schemes are much different. This is the golden pyramid where you have the insurance policy and the LLC at the bottom two corners and the very top. Upon death, you have that trust to protect your legacy, right? And to make sure that your loved ones have the correct and appropriate mourning period to mourn the passing of a loved one. And that more importantly than the mourning period actually is to make sure that California doesn't get their sticky fingers on all of your assets and all of your wealth that you built for yourself over your lifetime, and that your heirs are left with your legacy, hopefully in most cases tax-free. So this is all part of not only estate planning, this is part of wealth management and wealth planning, and it's all about, in your mind, you might consider talking to your tax advisor as part of the strategy to pay less tax, right? That's what everybody seems to be worried about these days, is paying less tax. I want to pay less. I don't want to pay more. Well, I like to talk to my clients in a different way and teach them a different perspective, or get them to see it from a different perspective. It's the same thing, in fact, but instead of thinking as tax planning or tax strategizing as helping you pay less tax, think of tax planning or tax strategizing as helping you keep more of your wealth, right? Because wealth retention is equal to tax savings. The less tax you pay, the more money you get to keep. So I know that taxes aren't exactly the sexiest topic to discuss, but it sure is important because it is a big part of how a business investor, a real estate investor, it's a big part of how you will end up retaining your wealth, through all of the hours and the weeks and the months and the years that you've worked so hard to obtain all of these assets over your lifetime. So just make sure that you understand that this is a big part of business, the taxation side of things. And we obviously all pay some sort of tax, right? But through proper planning, we can pay an obligation in tax, our obligation in tax, and not a penny more than that obligated amount. So keep that in mind. Very, very important, very, very important perspective to have when investing in real estate. Oh, I don't know why that just went backwards. Let me go forward. All right, let's talk about something that is very, very popular in today's investment world, and it is a special election that is made on your return, and that election is called cost segregation. In the accounting world, we call it a 481A adjustment. Now, some of you in today's webinar might have heard of cost segregation before, but for those of you who not are behind on the times, I can't really say that in the 18 years that I've worked in the tax industry that cost segregation has always been a hot topic to discuss. I've talked about it in more advanced courses that I've given, but it hasn't been very popular. In fact, I'd say that I've done more cost segregation elections in the past 2.5 years during the pandemic years compared to the full 18 years that I've worked in the tax industry. So I see this topic ramping up, catching a lot of traction, and really getting a lot of real estate investors excited on the potential tax sheltering benefits of electing cost segregation. So what the heck is it? It's not a new variant of COVID. Don't worry, cost seg is not another variant of COVID or anything. It's nothing to be scared of. It is merely an election to be made on a return to accelerate future year deductions, right? So imagine we can't tell the future, and some of us don't want to be able to tell the future. I'd like to see a little bit further into the future to see where COVID's heading and see where what our new tax bill looks like, so I can explain it to all of our clients. But a lot of us don't want to know about the future. But it sure would be a benefit if we could reach into future years and take deductions that we haven't taken yet, all in this year to help save tax today. Because I can tell you right now that if I could save an extra 10, 15, 20, 30, 40, 50 plus $1,000 in tax for this year versus waiting over the next 10, 15, 20 years to take certain write-offs, I would absolutely do that. My wife and I joke around about the Hamburglar saying. I forget how it exactly goes, but it's like, I will give you one hamburger today for 2 tomorrow, or whatever that saying is, right? I am all about taking the deduction today to save the dollar today so that I can invest that dollar, because I have control over my money today. I have no control over what the economy is going to be like in 3, 5, 10, 15, 20 years, right? Cost segregation's election allows you to do exactly that. Cost seg is an analysis of future year depreciation reaching out 5, 7, 10, 15, 20 years, not the full 27.5-year depreciation lifespan of a building or 39 years for commercial, but it only reaches out to 20-year assets. So what you can essentially do is, let's say you have a property that's paid off and it's cash flowing like crazy in 2022. You've paid off the mortgage, you have low property taxes on the property, you've done as much of the improving to the property as possible, so you're cash flowing like crazy, and you're thinking, well, I want to buy more property. I don't really have a lot of cash assets right now, but I am paying all of this tax. How can I save more money? And you've already kind of deducted everything that you know to write off on your return. Well, through a cost segregation analysis, this third-party analysis can tell you what future year remaining depreciation you have on 5, 10, 15, and 20-year improvements or parts of your asset, and you can accelerate 15 to 20-year improvements and take it all in 1 year, meaning that you are taking deductions instead of waiting for all of those deductions to kick in to save you tax. You are accelerating those deductions and taking them all in 2022. That is called a cost segregation analysis or election, and it can be made on this year's return, or it could even be carried back to past years. That's the craziest thing about cost seg. Now, some of you, if you've never heard of this, you're probably wondering why you haven't heard of it. Well, it's because a lot of accountants don't really understand how it works. And so what they don't understand in the Internal Revenue Code, they tend to fear, and so therefore they don't talk about it very often. Because Robert Hall and Associates, we work specifically, mainly and specifically with real estate investors as well as small business owners. We know these special elections to be made on a return. Now, we can't do the cost seg analysis for you. We actually have referrals. I'm sure that maybe even Marshall Reddick's team has a referral for cost seg, and if they don't, we have a great referral. It might even be the same referral. But we have to use a third-party vendor in order to make this election, and then they give us the paperwork to file with the return. We calculate what the 481A adjustment is, and boom, we're off to the races. And with all of that money that you're saving in this calendar year with that cost seg election, hopefully you're taking that wealth retention, not tax savings, but all of that wealth that you're retaining in your own bank account, and you're utilizing that and calling Marshall Reddick and their team to buy more real estate. Because that's the name of the game, folks, is to take as much of your money and invest it in the most consistent dividend paying asset you can park your money in, which is real estate, rental investments. Okay. I can give you a quick example of a cost seg analysis that I just did 2 or 3 weeks ago. I had a client who has a portfolio probably in the $2 million range, just a couple residential rental investments. One was a new property that they had purchased. It needed about I think 350 grand in improvements. And so what they decided to do after our call last year is go through the cost seg analysis, but wait to finalize the cost seg analysis until all of the improvements on the new acquisition were complete. The overall revenue that this client was showing was around $800,000 between his spouse's income. She's a doctor, he's a real estate professional. And I think they were able to accelerate close to, I think, $450,000 or $460,000 of future year depreciation through this cost seg analysis, including a majority of all of the improvements that they made to the property that they had recently acquired. Well, in that $800,000+ bracket, they're at about the 35% federal tax rate on the Fed side and about 10% state. So you figure that their effective tax rate is somewhere around 45%. But also you have to tag in the 3.8% net investment tax that they're paying, plus the kind of wealth tax that they get kicked in, because once you're above a certain income threshold, you have additional taxes that you pay. So overall, the ROI on the dollar amount that they were able to accelerate, which in this case was about $460,000, the ROI was about 51%, meaning that $460,000 in accelerated depreciation between federal and state income tax saved them over $230,000 in federal and state income tax. Now, sure, for the veteran investors in the webinar, you're thinking, well, if they ever sell those properties, the depreciation that they're taking now versus later, when they sell the property outright, they have to recapture the depreciation and pay tax on it. Yes, that's one of the pitfalls of depreciation, but only upon full disposition. That means that you are exiting out of real estate. You don't want to own the property anymore. You're not doing an exchange. You're just taking the money and run. You want to travel the world on your yacht and play golf on private islands and all that stuff. Whatever you want to do in retirement, that sounds like a nice dream for me. I'm working every day to get there, but at the end of the day, real estate is meant to really never sell. And if you do sell, you sell it into an exchange and you buy more real estate, right? Because the true benefit of appreciation while you're alive is to tap into the equity and invest in other investments. It's to invest, whether you dabble a little bit in the market or buy more real estate, to diversify your portfolio. And so the appreciation of value in the property is equity that you want to tap into and build wealth that way. But the benefit of the appreciation in value really isn't meant for you, is it? It is meant for your legacy, your beneficiaries. It is meant to be left as your legacy to your beneficiaries, because upon death, your next of kin or your surviving spouse, they receive something called a stepped up basis benefit on all of your capital assets, making up to about I think the estate exemption is around $12.3, $12.4 million right now, making all of your assets up to about $12.4 million tax-free upon death, right? So the whole benefit of while you're still alive, the real estate side of things, it's the cash flow benefit, the ability to not pay any Social Security and Medicare tax on all of your cash flow from your real estate investments. And that's number 2. And number 3, it's the tapping into the appreciation in value to acquire more cash flowing assets. That's while you're alive. In death, your beneficiaries will receive that stepped up basis, paying no tax on any sale of capital assets, but also even more importantly, if you teach your children the right strategies upon your demise, your children will keep those assets and restart depreciation on the fair market value of the property at the time of your passing. Imagine that. You bought a property for 200 grand, it's fully depreciated after 40 years. You die, the property's worth 1.5 million, your children inherit it tax-free, and if they decide not to sell it, their depreciable basis is based on the $1.5 million amount, not the $200,000 amount, okay? Now, they can't be on title before you die. That's one very, very important thing to understand, is your children cannot be on title. They have to be added to title in death, okay? Not before you pass away in order to receive all of these benefits. This is a big part of what we do. We do tax strategizing, tax planning, estate planning with our clients. More importantly, we talk about these very unique and special elections like cost segregation to help reduce liability now, retain wealth, and buy more real estate. Setting up new depreciation schedules on the newly acquired properties, maybe doing more cost seg analysis on newly acquired properties, and keeping you in very low income brackets while exponentially building wealth through real estate investing. I mean, it's a no-brainer in my book. Hopefully this is all making sense. I know that I sometimes talk quickly, but as you can tell, a very exciting topic to discuss and a very popular topic coming out of the pandemic and over the last 2.5 years. I don't know how long cost segregation has been around for, but I think it's been around for quite some time, because I remember hearing about it early on in my career, or at least the benefit of accelerated depreciation has been around for a while. But cost segregation, the term cost segregation in the industry of cost seg elections and filings has really grown exponentially over the past 2.5 years. So once again, if you're not selling your property outright, the only way to really dispose of a property and shake things up and maybe acquire more doors out of your one highly appreciated asset in Orange County or in LA is to do a 1031 tax deferred exchange. Marshall Reddick's team, they know the best people in the business. So if you are interested in entering into an exchange and you need accommodators, you need agents on the buy and sell side, you got to talk to the Marshall Reddick team. That's what they do professionally. And when you turn around and get ready to file the tax return, they're going to tell you, you got to call Robert Hall, right? Because you need the professionals on both sides of the fence. I'll tell you a couple statistics really quickly, and I don't want to go over my time today, but I want to give you a couple really important stats around the 1031 exchange industry. 1031 exchanges make up for about 16%, not 6%, not 60%, but 16% of all United States real estate transactions. It provides the industry alone, 1031 industry provides the global economy with over 600,000 jobs across the globe. You can exchange US property for US property, foreign property for foreign property, but not US for foreign property or foreign property for US property. So it has to be US for US or foreign for foreign, but not outside of country or inside of country for the exchange. And what this allows you to do is fully exchange the gain rather than paying tax on it, to exchange the capital appreciation, the capital gain into other like-kind real property investments. Okay, so it creates 600,000 jobs globally. It makes up for 16% of all real estate transactions here in the US. And most importantly, it generates $40 billion+ of revenue for the federal government every single year. And here we are talking about a new Internal Revenue Code that might change Section 1031 of the Internal Revenue Code and start limiting the overall gain amount to only $500,000 per taxpayer. So if you're single, if this part of the code does pass, which nothing has passed on this yet, they've got a lot of other things on their plate right now. I think they're probably going to pass the new bill closer to either the end of the year or beginning of 2023, but they are talking about introducing a cap to what can be exchanged through a Section 1031 like-kind exchange. It would be $500,000 for a single individual, $1 million for married filing joint couples, which means that your $200,000 investment that's now worth $2 million that saw $1.8 million in overall appreciation, married filing joint couple, under the new rules, potential new rules, once again, nothing is set in stone, but under the potential new rules, you'd be allowed to defer $1 million of the gain, and you'd have to take the $800,000 in excess of gain and recapture depreciation and pay capital gain tax, long-term capital gain tax on that $800,000, minus improvements and closing costs, all of those other adjustments, but you get the gist of what I'm trying to tell you. I don't understand why the federal government would try to change part of the code that's been around for over 100 years. Section 1031 is one of the oldest parts of the Internal Revenue Code, real estate related parts of the Internal Revenue Code. I just don't see why they would want to change this. And that's why I think that this particular part, personally, I'll tell you, I don't think this is going to change. Professionally, I have to tell you, my head's on a swivel because, listen, coming out of the pandemic years, anything can happen. That's truly how I feel these days. Anything can happen. Who would have ever thought that we saw the stock market just absolutely, you know, catapulting into the hemisphere prior to the pandemic? Business seemed to be going well. Other things in the world were not doing so well, but money-wise, I think that a lot of people were doing well in business and real estate. Interest rates were low, so on and so forth. Pandemic hits, we go through this whole rigmarole where the federal government freezes interest rates and then it drops. I had clients locking in 2.9% 30-year fixed interest rates. I don't even know how the heck you find that. It's like throwing a dartboard 100 yards into a dartboard. I mean, it's nearly impossible. It was a very, very small window to lock that in. And if any of you have locked that in, great, good on you. That's amazing. But we saw a lot of change over the past 2.5 years. And that's not what I really want to see moving forward. I know for a fact that a majority of Americans have their wealth built in equity in real estate. I know that a lot of people's retirement is built in equity in real estate. And if they were to sell it and be limited to the amount of gain deferral, guess who wins? I don't think the taxpayer wins in this situation. I don't even think the US economy wins. You know who I think wins? I think politicians win. I think the government wins because they are going to collect more revenue if this changes under the new Internal Revenue Code than they ever, well, that's what they think. But if you kind of map out these scenarios, what do you think is going to happen if they start capping the gain? Less people will exchange their properties, meaning less people will be selling properties. And you know what the #1 stimulator of the US economy is? Real estate sales and acquisitions. Think about how many jobs are created upon acquisition or in an exchange or upon sale of property. You're creating 60, 70, 80, probably even more jobs from the construction workers to the mold inspectors, to the termite inspectors, to the couriers, to the title reps, to all of these things on the acquisition and the sale, and the realtors who get paid, and they spend money with marketing and advertising and travel. I mean, you're talking about the hub, the true thing that stimulates the US economy, and the federal government is trying to change a part of the code that's been in the code for over 100 years. Absolute insanity. But once again, I don't personally believe this will change, but we need to have our heads on a swivel and be readily available to make any moves in case the federal government does decide to change this part of the Internal Revenue Code, Section 1031. Another big change that kind of ties into 1031 is the potential change to long-term capital gain rates. If you do in fact have capital assets that bump you as a single individual above $500,000 or a married filing joint above $1 million in household income, every dollar above those two thresholds, depending on your filing status, every dollar in capital gain or investment income above those two income thresholds, long-term or short-term, could be subject to 39.6% long-term capital gain tax. Yes, I said long-term capital gain tax. We all know long-term capital gain as kind of the unicorn tax rate of the industry, right? It's the 15% federal long-term, or if you're a high-income earner, it goes up to as high as 20%. Then we've got a little 3.8% net investment tax that we pay, and that's you paying into free healthcare here in the US. That's been around since 2012, part of the Obamacare bill. But now the federal government is saying if that capital gain bumps you above $500,000 as a single individual or $1 million married filing joint, every dollar in capital gain or investment income above those thresholds would be subject to 39.6% instead of 15 or 20%. Well, that's not even including your state of California income tax at 9.3% plus 3.8% net investment tax. So if you have that golden property here in California that you saw $2, $3, $4, $5 million in appreciation on, and you're looking at that massive capital gain, you're thinking, well, I'm just going to exchange it all into 50 units elsewhere in the US. If this part of the code does change and they limit your gain to $500,000 or $1 million through the 1031, and the rest becomes capital gain, guess what? That $1 million, $2 million, $3 million capital gain is going to bump your household above those thresholds, and now you're paying over 50% of your capital gain above those two thresholds in federal and state income tax. So don't you think it's important to not only, number one, understand what changes are on the horizon? Once again, none of this has been set in stone. We thought we'd have this final Internal Revenue Code back in October of last year. Here we are, June 22nd. We're still sitting here twiddling our thumbs, sweating bullets in our offices, trying to figure out what direction the federal government's going to go. And it's very unfortunate that the government would drag the U.S. taxpayer through the dirt, through the mud, up and down hills and through paper shredders, however you want to compare it to, how the government would do this to us, the U.S. taxpayers. Some of you might be saying, well, the government does this to us year in and year out. Well, I understand that, but this is probably going to be the most significant change to the Internal Revenue Code, dating back 35 plus years. Probably back to the time when alternative minimum tax was first introduced back in the 80s. So we have to understand that if this does change, that we need to sit down more so than ever before and plan and strategize to help retain a lot of the appreciation and wealth that you built for yourself, and not just make rash decisions with our investments and pay Uncle Sam and the state agencies any more than your obligation amount in federal and state income tax. It all comes down to the power of planning. I can't even stress that enough. We call it POP here in our office. It's a very cheesy phrase, but POP, the power of planning. You need to set aside some time towards the end of each calendar year to sit with your tax advisor and map out a plan. So keep that in mind. I do want to end on this note and just make sure that everybody understands that you are not alone. If you feel like the information that we discussed today was confusing, that it was stressing you out, and now you're going to go and have a strong glass of something cold, just understand that you are one of millions of taxpayers here in the US that feels the same way that you do about the Internal Revenue Code, about the federal government, the fear of audit. This is a big part of what we do in our industry, is we try to ease those fears. We try to talk to our clients about how to be overly aggressive, or show them what overly aggressive is, what is safe, what is the more of the safe side of the line. But we want to be right at that line. We want to be aggressive, but up to the safely aggressive marker. So through this free consultation, we'll review 2 years of filed tax returns. If you file for 2021 and 2020 already, we'll go ahead and review those returns. If you are on extension for 2021, we'll review 2020 and 2019. We'll check for any possible audit triggers. We'll add you to our periodic tax email updates, letting you know about upcoming webinars. And as soon as we have this new Internal Revenue Code, I'm the only public speaker for my firm, by the way. I'm trying to get other people on board with doing public speaking. We're not quite there yet, but I think we have a couple promising stars coming up here in the next year or so with our staff. But we'll put you on our periodic tax email update, letting you know about our upcoming webinars. And as soon as I have that new tax bill in my hands, I'm going to take about 48 hours, maybe a week, to study that, put together a new PowerPoint, and be right back with you with all of the updated information. I don't think, or I don't foresee very much changing for self-employed individuals, meaning the property managers, the wholesalers, the rehabbers, depending on if the federal government decides to open up the 1962 or 1961, 1962 Internal Revenue Code that kind of brought forth all of the real estate professional tax benefits that are built into the Internal Revenue Code, which I don't foresee them opening up at the moment, at least. I don't foresee anything major changing for the self-employed individuals. It's really for the real estate investors who move property every single year, whether they're doing exchanges or carryback financing or installment sales, or maybe even not even a full-blown like-kind exchange, maybe doing a down leg exchange, accessing cash out of the exchange, paying off personal debt, and only, and limiting your overall capital gain exposure to a certain portion of your property sale. There are a number of ways that you can mix and match property exchanges, but that's a really, really important part of this new bill that I'm really hoping, crossing my T's, dotting my I's on the information I'm giving, making sure that everybody knows that this is not final, but definitely knocking on wood to make sure, or at least for my own peace of mind, that this will not change. It is a powerhouse of the Internal Revenue Code. It allows people to retain wealth and move money free, outside of California, inside of California. And as long as you are kicking that tax can down the road, I love this phrase, I use it in every webinar, as long as you are kicking that tax can down the road in a 1031 exchange, you will never pay tax on the deferral of gain or recaptured depreciation, even if you kick the can. Right? Kind of a funny way to look at it. So you want to make sure that you never sell property unless it's exchanged, right? And you still need the agents, you still need the accommodators. That's why you're going to talk to Marshall Reddick and their team about how to enter in, what the 45-day identification period is all about, what the 180-day closing period is all about, and why it is so incredibly important to identify at least 3 properties before you even entertain the idea of an exchange, or within that 45-day identification period. And we try, you know, we play it very close to the chest sometimes, but we do not want the exchange to fall out. I had one client fall out of the exchange in 2021. They sold in December of 2021. They were looking into, they only identified one property. They decided to identify one property in San Luis Obispo, and they weren't able to close on it. And now they are seeing a pretty sizable liability on that. And it wasn't anything that they did. It wasn't anything that we did. It was simply the county of San Luis Obispo that could not get the paperwork together. They couldn't get their act together in time to, I think it was something with the permitting or the running of pipelines to the property in order to qualify it for the exchange. It was very, very sad. But at the end of the day, they'll be fine. They make good money, and they've got good real estate investments, and they have enough saved away. And they thought that this was a potential result. But I want to make sure that everybody works with companies like Marshall Reddick to make sure that they button up these transactions. It's incredibly important to help yourself in ways where you build a team around you to make sure that your money is bulletproof and that it stays in your account and not in the government's. Okay, I'll get off my pedestal now, but I wanted to leave you with that. I think I've left this screen up for long enough. You got to text Robert Hall to the number 72,000, or if you are a tech junkie like I am, you can open up your smartphone camera, scan that QR code at the bottom right part of the screen, and that automatically prompts you to sign up for a free consultation. If you have questions, definitely include them in the questions, the Q&A section, or in the chat box, because we want to be able to get those answers to you as efficiently as possible. And I know that I know that Marshall Reddick's team has all of this on there, and I know that Nicole, if you have questions for Nicole, definitely include those as well. If you can't think of the questions right now and you think of them later, you have our contact information. Anybody at Marshall Reddick knows who I am, knows who we are at Robert Hall & Associates. We've known their administration, their team for a long time. So if you need our contact info, contact them. If you contact us, we'll share their information with you because we only work with the best in the industry. So thank you so much, everybody, for attending. Really appreciate it. Nicole, if you want to say any last words here.
Yeah. Thank you, Tony. No, that was a lot of information, a lot of very good information. So we always appreciate you breaking everything down for us. I don't see any questions yet. And definitely, we don't have time to answer them now, but that doesn't mean we don't want to hear them. So definitely shoot me an email. There'll be a follow-up email going out. I'll check in with you. We do want to make sure you get any questions answered. But yeah, it's almost 6 o'clock. Thank you so much, Tony.
Perfect. Yes, thank you so much, Nicole. Everyone stay safe, stay healthy, and we'll chat with you soon.
Yeah, everybody have a good night.
Take care.